thank you so much for joining our blockchain series, today Blockchain 201, to learn about this incredible technology and how it has transformed industries like finance, supply chain, gaming, and others. At Republic, we believe that disruption is inevitable. And as we look to bring businesses with great potential to our platform, we keep a close eye on opportunities and trends in the industry. Whether you are here merely to learn or look to invest one day, welcome. We love having you on, and we hope that you will find the material relevant to you. In case you missed, we held a 101 class on blockchain that covered the important fundamentals of the technology. I see that some of you who join us for 101 are also in for 201. It makes us incredibly proud and grateful for your time to spend with us. So if you missed the 101 class, I have shared the link in the chat section of the recording. It's called republic.co/blockchain101. Take a look at it there. So first, a bit of introduction. I'm Sandra Ford, an operating partner here at Republic, responsible for portfolio and investor relations. I reside in New York City, where Republic is headquartered. Our speakers are calling in from LA, I believe, and San Francisco, respectively. That said, our team is quite international and dispersed out globally. I think that our team is coming from something like 10 countries. I'm Hungarian. Why should you care about blockchain? I think if you are in this class 201, you already care about blockchain and you understand the fundamentals. A lot of the large companies have adopted blockchain technology, and the cryptocurrency market is inching towards 300 billion globally. Top universities are teaching courses on blockchain, and understanding the space will empower you to see the world as it progresses forward. But enough said. Brian, one of our speakers, please take it away.
Thanks, Sandra. Thank you for the great introduction, and welcome everybody to Blockchain 201. Here you go, let me get it, there you go. Oops. Yeah, welcome to Blockchain 201. For those that tuned into 101 last week, welcome back. Super glad to have you guys. I see a lot of familiar names. But yeah, I'm just gonna give myself a quick introduction, and I'm also gonna have Alex, our next speaker, do an introduction, then we'll go right into it. But for those of you that don't know me, my name is Brian. I'm the co-founder at Republic Crypto, and I've been working in crypto, doing various things, mining, researching, investing, since 2016. I feel like maybe that's not a super OG date, but I've been really into it for a while, and really love seeing this industry grow and helping to progress it at Republic. Before my time in crypto, I've done everything from strategy consulting for large Fortune 500 companies, and I've also worked at super small startups. So hopefully my experience working at the whole gamut of a spectrum of companies can be helpful in explaining how blockchain can be useful for you guys. I also have a technical background. I graduated an engineering degree from UCLA. And that also helps me kind of have a more technical grasp on why blockchain is important and how to really understand, the benefits of this technology. And then before I hand it off to Alex, I just want to say, during the course of this presentation, feel free to ask questions in the chat. I love to engage with you guys real time and answer questions real time. So if anything is unclear, please pop it in the chat and we'll do our best to address it real time. With that, Alex, take it away.
Awesome, thanks Brian, and welcome everyone. Excited to be on our next installment of this whole blockchain series. So I at Republic am sort of their de facto economist, and I lead the investment and advisory practice here for all of our fintech and blockchain companies. Plenty of experience doing due diligence, both on the fund side and direct side. Started my career in venture fund of funds, and everybody wanted to know what my opinions were on crypto, given that I have an economics background. So I actually ditched econ grad school and went and got into this industry, and having a blast. So looking forward to answering all your questions today. We're getting a little more into the weeds in this session, and yeah, really excited to hear what you guys have to think at the end.
Awesome. Thanks, Alex. All right, we're going to dive into it because there's a lot of material here today. This is the 201 class, so we're going to assume that you guys, have some basic understanding that was outlined in Blockchain 101. But again, if you have any questions, please just pop it in the chat. But just so you guys have an overview of what we're going to be going through, we have 4 modules for you guys today. The first one is just basic blockchain terminology, maybe a little bit more than basic. We want to get you guys understanding what the jargon is in the industry and how to understand what people are saying when you're talking to people that work in the industry. Secondly, we're going to dive into some popular blockchains and cryptocurrencies, so you guys have an understanding of who are the major players out there and what are their defining characteristics, so that you have an idea of what the landscape really looks like. Third, we're going to go into the investment landscape itself. So what that means is what kind of investment opportunities are out there, what types of companies are in the blockchain industry as a whole. And then lastly, we're going to talk about how to evaluate these companies. So think of due diligence. So I'm going to take module 1 and 2. Then Alex is going to finish it off with modules 3 and 4. Some of these technical terms that I wanted to kick off with are consensus models, the concept of decentralization, which we talked about last week, smart contracts, forking, and staking. Consensus basically is the way that blockchains come to agreement on what data is stored on the blockchain. So if you guys were part of the session last week, we learned that blockchains are basically packets of data that are chained together, and these data packets are organized in blocks. But how do you know which piece of data goes next? And and there are different ways to do that. And that's called the consensus model. And because blockchains have different nodes in many places, and there's no central authority that dictates where the data goes, there has to be a way for all the nodes to agree what the data is. So that's called a consensus model. So Bitcoin, Ethereum, other blockchains have different ways to come to consensus on how that data is organized. And 2 popular ways to have consensus are proof of stake and proof of work. I'm not going to dive into that right now because that's pretty complex and I have a few more things to go through. But just so you guys understand consensus, these are ways that different nodes come to agreement on the data that's there. So for example, on the Bitcoin blockchain, if I send money to Alex and Sandra, that transaction is broadcasted to every node on the Bitcoin network. But how do all the nodes know that I indeed did that? It's through the consensus model. And that's some really complex math stuff that we'll probably save for something like the Masterclass, introducing that idea for you guys. Next up, we're going to go into decentralization and trustlessness. Touched on this a little bit before, but decentralization is basically where you're going to hear all the time. Every article, every post, every conference, you're just going to hear people say that word. It basically means that there is no main central player that dictates the direction of the company or dictates what is in the blockchain. So for example, there's no CEO of Bitcoin. There's no CEO of Ethereum because they are decentralized. They're owned by the people that run the nodes. And because they are decentralized, you don't need to trust the CEO or trust the company itself to progress the technology or to make sure your data is safe, because you're actually trusting in the program that the blockchain is built on top of. So because you're trusting in the program, you don't need to trust in a person, and that's why it's called trustless. I know it's a little bit hard to wrap your head around because you're not trusting it. It's just that you don't need to trust it. Therefore, it's called trustless. We do have to, yes, exact, good point. We need to trust the developers who are maintaining it, but that's where the open sourceness of blockchain is important. And we discussed open source last week, and anybody can audit and look at these contracts to make sure that they're good. And if they're not, then they get called out. So because they're open source, you can trust the code, and that's why they are trustless, because you don't need to trust something you can't see. Exactly, giving the power back to the people, right? That's exactly it. We're democratizing the technology. The next thing I want to talk about is smart contracts. I think smart contracts is something like I got a lot of people that registered for this class asked about smart contracts. I want to talk about it. We'll also talk about it when we go into Ethereum. But smart contracts are basically a way to make money programmable. So Ethereum, which is a very popular blockchain protocol, has introduced a concept of smart contracts, which means that you can now like programmatically write code that exchanges financial information, and you don't have to deal with like a bank or a broker to do that. You just write a program, and because they're open source and trustless, these are now called smart contracts, where there's no intermediary. Thank you, Letitia. And you're giving power back to the people that are like running these transactions. So that's like the beauty of smart contracts. Forking and staking, basically, if you look at Bitcoin, Bitcoin has many different forks. So you have Bitcoin, Bitcoin Cash, Bitcoin Gold. Forking just basically means you take the original blockchain and you literally copy it and you create another version of it that basically forks off the original code. And that's why there's a fork. Staking, we'll go into actually the next few slides. I'm not going to take too much time there, but I wanted to make sure that you guys kind of understand these basic fundamental technical terms. Why do we need a fork? So we don't actually need forks. It's just that when there's a disagreement in the developer community, they were like, okay, I want to take the product this way, and then maybe like the original crew wants to take it that way. So then they decide to fork. It's almost like just having a different train of thought, and they just go separate ways, and the community can decide which way they want to follow. All right, industry jargon. So these are words that you guys are going to hear a lot in conferences. You're going to see this in your emails. If you talk to anybody in blockchain, like DeFi, airdrops, tokenization, these are all kind of buzzwords that you hear, but I just want to define them for you real quick. DeFi stands for decentralized finance, which is, blockchain promotes, these kind of decentralized applications. And a lot of people have found really awesome use cases in finance. So you can now use smart contracts, use programmable money to have a decentralized finance tool or decentralized finance applications. And that's a really popular vertical of blockchain called DeFi. Airdrops. You can actually find some airdrops on Republic, but airdrops are basically a way to give away tokens to people. And it's really used as a way to grow a user base or to like kind of market and gain traction to kind of like jumpstart the adoption of this particular token by giving it away. And basically by having it in the hands of as many people as possible, you now have a lot of users, and they're like, oh, I got this free token. Let me see what I can do with it. It's a really like blockchain native way to kind of like kickstart and jumpstart an application or a project. Those are called airdrops. Tokenization. Tokenization is the act of turning something that can be digitally represented into a token. So a popular thing that gets tokenized is like equity or shares in a company. They can be represented by security tokens. I also got a lot of questions on, initial coin offering, ICOs, a token sale, security token offerings, STOs, and initial exchange offerings. These are all different ways and different mechanisms that people are selling tokens. They have different words because they come from, are they legally compliant? Are they not? Which jurisdiction did they come from? What is the medium that's hosting the sale? So all those kind of factor into what those are. But essentially when you hear these words, you're thinking about a fundraise. So yeah, airdrops, they're like rewards or they're like both. They're initial credits. They're basically like you own these tokens for a certain project, and then you can use those tokens in the project for some way. So they can be used for voting. They can be used for purchasing things in the product, getting a discount. So it really depends on the project. Wallets, exchanges, you guys might know these already, but a wallet is a digital wallet where you get to keep all your tokens. So, if you have an account on Coinbase, and you probably have a wallet for Bitcoin or Ethereum. It's just a digital way to represent the tokens that you have. Exchanges are places where you can buy and sell tokens, very much like a New York Stock Exchange or NASDAQ. White paper, you guys will hear this a lot if you look into any blockchain project. We have our own white paper at Republic. A white paper is basically a technical document that gives you an overview of the project. So like it's something that you can read and have a clear understanding of the project itself. So like the original Bitcoin white paper is something that you wanna read and understand if you wanna understand what Bitcoin is. It's just an explainer document. Going into popular blockchains and cryptocurrencies. These are ones that I think that are important for you guys to understand because they're pretty well known. They have a lot of users relative to other blockchains. So I just thought these would be interesting for you guys to kind of have an introductory idea of what popular blockchains are. And again, feel free to take photos of these and keep them for later. And we'll also be sharing the recording. But Bitcoin and its many forks are primarily used as a store of value or a speculative investment. A lot of people are like investing in Bitcoin, right? Because they think the value might go up. So that's primarily what Bitcoin is basically money in digital form. People think of it as digital gold because it's scarce and it's controlled scarcity and is very, very, very secure. Ethereum, which is probably the second most popular blockchain, has pioneered the concept of smart contracts. So these are, a really interesting way you can think of smart contracts is like if we're making sports bets, right? So say Abhishek, me and you, we're making a bet and we're betting that the Los Angeles Lakers are going to win the NBA championship. Typically, we have to go to a casino or some like online intermediary to like do that, and then the house takes a cut of like the money that we exchange. However, with a smart contract, we can just like send our ETH or Bitcoin or whatever into a smart contract address. And then when the result is done, we both get the payout as a pure probabilistic payout because, there's no intermediary to take the cut, right? Like there's no work that needs to be done. It's just a program. So that's like smart contracts. You can actually extrapolate that idea to escrow for homes or just like any sort of like probabilistic outcome and like create these like conditions in which money is sent. And then you can even like extrapolate that further, and it could be not just money, but any value. It could be art, it could be anything that can be represented digitally. So like with the concept of these smart contracts, you can now make a lot of things programmable and also disintermediate the middleman, hence like saving money and making things more efficient. So that's kind of like a primer on smart contracts and what Ethereum has really pioneered there. Another thing is Ethereum kind of brought together the ERC20 token standard. So a lot of projects use this, and a lot of tokens, like it's really easy to create tokens on Ethereum because they created the standard. So you'll see ERC20 a lot, which means that they're built on top of Ethereum. Binance Chain, you guys all probably familiar with the exchange Binance. They have their own token where if you use that token, you get reduced fees, and they're also using that token for like staking and voting and a bunch of other stuff. So the token is very versatile. You guys probably heard of EOS as well, another popular smart contract platform. Their consensus model is called delegated proof of stake. Again, we'll get into like the details of that in the masterclass, but they have a different consensus model where there's 21 validators instead of like anybody's a validator, which makes it really fast, but also makes it a little bit centralized. So things to think about, and maybe think about like the proper use cases. Then you have Cosmos and Algorand. Cosmos is a blockchain that promotes kind of like interoperability. It connects lots of blockchains together, right? So you have Bitcoin, Ethereum, they don't really talk to each other, but with Cosmos and other technologies, they can actually talk to each other. And I think that's really important because then you can like kind of bring all the communities together. Algorand is another blockchain. It's a pure proof of stake blockchain that's like really trying to, from a mathematical standpoint, solve the blockchain trilemma, which is scalability, security, and decentralization. Once you dive deeper, you'll realize that like you can't have, you can't have scalability, security, and decentralization at the maximum. There's always give and take. So Algorand's trying to find like the best mix of that. Yeah, so those are kind of like the blockchains that you guys should know. There's like literally thousands out there, but these are kind of the most popular ones. out there. And yeah, feel free to ask questions. And yeah, hopefully that was a pretty interesting primer for just like words you should know and blockchains you should know. I'm gonna pause there. Does anybody have any questions or feedback? Like, does that make sense? So yeah, POS stands for proof of stake. So proof of stake is a type of consensus that basically allows people to stake tokens so that they can help secure the network. And I know some of those words are a little bit complex, but we'll dive into that in the masterclass. But just for now, just understand that consensus is a way for different people to come to an agreement on what the next data that's stored on the blockchain is. Take it away, Alex.
Hey guys, and thanks so much, Brian. I know you guys have a lot of questions out there that can all have their own presentations themselves. Don't want you guys to be scared. What I'm going to take you guys through now is a high-level overview of the landscape, or the investment landscape specifically. What are all these cryptocurrencies you might be thinking of? So I personally like to look at the whole landscape in terms of the problems they want to solve, right? And so some of the large topics I'll go over very briefly are, for example, infrastructure. You might hear around, well, are you investing in infrastructure nowadays, or some crypto venture fund continues to back infrastructure? So what that refers to is the fact that blockchain is still quite new. While it's been around for a few years, there are still a lot of technological advancements we can make so that blockchain can be best optimized for the problems we want to solve. So you might find companies that want to let blockchains talk to each other, those who want to make the hash functions easier to do with different, computer science magicianship, and also others who want to press the absolute limits of the throughput we can get with blockchain. And those are all very important for the long-term goals. And then I guess more specifically on looking at the verticals, you'll find a lot of different industries that blockchain is trying to sort of pitch its value to. One of the most popular for the past couple years now has been in financial technology. And so whether that is creating derivatives, being able to originate them, or to lend cryptocurrencies on a marketplace, or to have a payment protocol that lets people transfer cash globally without borders at a much cheaper rate than you would have to go through with the government. And so fintech itself is a massive umbrella. And so we could go in depth about that, but just think about this, everything in the current financial world, and potentially more, can be attempted to be replicated in blockchain. And what we want to answer is which one of those use cases does blockchain best suit it, right? So moving on from fintech, we go into like enterprise data and IP. So some of you might have heard of Hyperledger or Salesforce, right? IBM and Salesforce as massive enterprises in the space who work with tons of Fortune 500 companies want to adopt blockchain to help a group of their existing customers or conglomerates to exchange data all under one transparently visible place without any one single entity controlling the write and read permissions. So that's a big time initiative on the enterprise side, and it can be vastly different from that on the financial technology side. And then to go on to another more brute force usage of blockchain is the renting of decentralized computing. So many of us now, I know a lot of you out there might be very technical, or certainly have been looking at a lot of the ways in which computation power is becoming very, very valuable, whether that's running machine learning models or mining Bitcoin. It's less efficient in general for someone like myself to buy a massive like 5 NVIDIA graphics card rig to mine Bitcoin or to run massive machine learning models. And what decentralized computing is going to allow us to do is for those who own these large rigs to rent out their computational power to other people who want to use it. And this is the type of competition that's going to be knocking on the door of the AWS services of the world in terms of finding a way to have a more market efficient solution to renting out that computational power. And then finally, and probably one of the more social and philosophical questions that blockchain tries to answer is on identity and privacy management. So imagine a world where you could be safe knowing that you can log into every new social media platform like TikTok or Instagram, Facebook, and even on, say, like your HR registration. Being able to take that information from a blockchain, which securely stores your data and prevents it from being tampered or directly accessed by any other party, is one way for us to really smooth out that user experience and protect them as we use more and more applications that a lot of large companies are profiting off of because of the data that they collect on us. So that's one way that blockchain can potentially give users, the ownership and security of their data. So yeah, and before we move on to the next slide, I want to have a big disclaimer that you might see a lot of these different investment opportunities out there, and it won't be necessarily always clear whether they're issuing an equity or a token or both, or honestly, some of the more crazy ones even issuing 2 tokens. We're not going to get into that level of depth today, but always be sure to know what exactly you're investing in from the company. So with that, we'll go on to the next slide. So, when we talk about tokens, they generally don't fit into one particular category very neatly. So that said, I like to say they have certain behaviors. So whenever looking at a token as an investment vehicle, you might see it proposes certain behaviors. The first and foremost is securities, right? The more traditional side of thinking about equities and loan obligations and things like that. And the key thing to understand there is what are the underlying assets under that token. For famous example is real estate. And others would be like, if it's a company, then you would evaluate it just like any other startup in the world. Where are their future sources of cash flow, and how do you discount that with time? So that's very fundamental finance economics. Now we get into some of the more interesting ones, utility and currency. With utility and currency, you might see a lot of people wanting to invest in a utility early on, say Ethereum, and what they're essentially saying is that we think that the decentralized computer that Ethereum is providing and the gas that runs it is going to be valuable. And that is at a constant trade-off with the present utility of using that decentralized computer. So this is to say that if you own any utility token, you as an investor and potentially as a developer have to evaluate what is the value of using this utility right now to, say, run an application versus what is the future value of it in the future, the future value of it, right? And that goes the same with cash. Sometimes our dollar can become stronger, and the question becomes, do you want to spend that money now, or do you want to hold on to that money as it potentially appreciates? So that's a sort of trade-off we have economically there. And then finally, we have governance, and governance is definitely the most philosophically interesting one. And what governance tokens are, as you might see with examples like, say, Compound, is essentially saying we want to reward good governance of how to run this protocol. And your tokens, your governance tokens that you buy into will increase in value as the community around it grows. And in that way, it will allow people it would reward people for keeping a community stable and happy. The only risk to this is when, as Brian has mentioned before, on forking or dissent, right? So if you can grow, say, a country as large as you want, but the double-sided edge of blockchain is that when anybody wants to dissent from the original community, then you're essentially at odds with 2 sides in the most simple example. So with the risk of dissent, you would essentially, if it splits 50-50, then the market value of either of those chains would be half and half of the original. So that is the risk with governance, but that's sort of how you have to evaluate tokens that that have governing behaviors do. And then, more on the technical side, obviously you need to, this is one reason why it's very important to know all those pieces of jargon. Not every blockchain is built the same. Some can require less people to see and validate the data, and others would demand that as many people as we can read the data. And in that slew of design trade-offs, we see that blockchains can be optimized for things like transactions, applications, store of value, or pure security, right? And which is to say, there's plenty of ways to attack those facets in order to achieve the function that you want from it. And then finally, and this is both technical and economic, there's going to be multiple participants in any blockchain, and that can be a slew of investors, miners, other types of speculators, and stakers. And one thing you'll always want to know, and this is where things certainly get more complex, is are all of those parties properly incentivized? And I'll be talking about that a little more in the next slide. Now, let's get down to the nitty gritty. How do we actually evaluate these companies? And the one thing I want all of you guys to take away is that it's not that scary. I know that a lot of you in this chat have invested in a company, perhaps on Republic or separately, maybe on, say, AngelList. And the number one thing to know about blockchain companies is that you should not hold them to any different of a standard as those other technology startups. All of their fundamentals are the same. I'm going to give you guys some brisk examples of how to apply your fundamental knowledge to looking at a blockchain company. So next slide. Perfect. So as always, we want to look at a business in its fundamental properties. And one you're all probably very familiar with is, the market size or the problem or the opportunity size, right? So in this sense, we need to identify what blockchain is actually being used for. In a world where we want to process millions of financial transactions versus, or in a world where we want to process a lot of financial transactions, so a good way to think about it is that the decisions are already made. We know who we want to transact, and we know that we want to transact. But in a world where we're thinking about IP and people are afraid of essentially trust, or you say people plagiarizing, taking credit for, not properly citing, we have a lack of trust. And what blockchain does here is it increases the efficiency in which people can make those decisions because the efficiency in which they can make those decisions, whereas on the financial transaction side, they just want to get it through. They want it fast and they want it cheap. So in this sense, what I'm trying to illustrate is that blockchain, at the end of the day, has to provide something that makes the process faster, easier, or cheaper. And in this case, it illustrates the sort of bifurcation of where decisions are already made in the financial world and where decisions cannot be made yet because of the lack of trust. So that's the general idea of, say, problem or opportunity size. And then next, looking at the defensibility of a product or that service. We have to always look at the pros and cons of adding another technological layer to solving this problem, right? So when any company comes up to me and says, oh, we're going to add this token to facilitate this type of behavior, well, I always have to ask, is that, for example, in a media streaming platform, do you really need a token? Do you really need a token to add extra complexity for your users? And if so, how are you going to educate people to be able to use your platform the same way that they just click a button to get onto Netflix, right? So that is one way we want to examine the frictions of using a token in any company, just like any other technology. And then probably most importantly, on the early stage side of investing, it's the team, it's the credibility, right? You like to, especially in emerging technologies, you want to see folks who have been through the ringer before, went through the same roller coaster of growing a company and dealing with things like regulations and competitors in the space and how they leverage and what their histories were working with them. So that's certainly a more qualitative analysis. At the end of the day, just like AI, AR, VR, or the newest biotechnology, can this company translate that emerging technology's value ultimately into a sellable product? Never forget that, no matter the technology you're looking at. And then finally, let's talk about money, key metrics and growth milestones. At the end of the day, what I demand from every founder who talks to me is, tell me what your growth plan is. Tell me what you look like in 2-3 years. Not with any certainty, but what you'd like it to look like, right? How do you start off making a little money, and how do you make a lot of money? It's a very dumbed down, very easy thing to ask for people. Some people go for profit first and then try to acquire volume later, and others that's very popular in the late 2010s is to go for volume first and then go for profit later. But obviously both have their pros and cons, and both can be upsetting to investors at early and late stages alike. And then finally, specific to crypto, one of the big differences with tokens is that there's a whole market to liquidate them earlier than they are exited. So the traditional venture-backed company doesn't pay back their investors until it gets acquired by a large buyer, or it IPOs or onto the public market. The only difference with crypto is that there are other private players, namely a lot of OTC desks and more popularly exchanges, which help crypto issuers list their tokens on secondary markets earlier. And things you'll need to know about whatever investment you make in tokens is that a new time horizon. When are they going to think about listing, and what is that going to do in terms of how much you have to manage that token before it gets listed and after it gets listed? So yeah, those are some of the fundamentals. I hope that wasn't too much, but the main takeaway again is that none of these questions are purely unique to crypto. They all stem from fundamental intuitions on investing in startups. Awesome. So, and then finally, you have to think about your place as an investor. You know, those business fundamentals, they can exist more or less in a vacuum, right? So when thinking about your position as an investor, you can shop for all the shiniest things out in the market, but at the end of the day, price is what drives your multiples, right? So how much of the company or how much of the network these crypto issuers are issuing, you want to know what portion you're getting as an investor and how many other investors are going to get. And then what allocation of that network is going to be mined or staked by other validators of the node. And then finally, how aligned are you with the founders, right? The founders are the ones who should be the longest term partners with this token. So you want to know how much they still own, because if they own nothing, then why do they have any incentive to stick along? And that brings me to economic alignment. Something you're going to hear a lot with this alignment piece are things like vesting and lockup periods. Obviously, if any of you have worked for any tech company or had stock options, they'll have vesting periods, cliffs, lockups, right? These are all terms in traditional finance as an investor that you'll need to keep a lookout for in crypto, and make sure that people aren't going to essentially be able to drop and sell a ton of tokens before you get the opportunity to. And that's what I mean by being aligned. We want to be on the same page as to when we can profit together from taking part in one of these companies. And yeah, that's really all the major high-level considerations. Again, any of these topics I put on the page can have their own long presentation and even jacuzzi hot tub discussion. So with that, we'll go ahead and talk about our masterclass, right? So we wanted to get a little bit more in the weeds, but as you can tell, probably with how I'm speaking, how Brian's speaking, there's so much more to learn. And with the masterclass, what we want to do is bring you guys not just into these, sort of lectures and high-level explanations of what is going on, but we want to take you to the day-to-day work that Brian and I do, looking at the industry real time. Right, and it's all about having the right takes and examining things like, one, the layers and interoperability in the blockchain system. I know it's a mouthful of words, but it's a super important topic when we think about how this industry is going to move forward. And then two, as an investor, historically, what should you look at, right? In general, people say that crypto has been performing better than blockchain. So we'll take you through what that actually means and how that compares to other venture investments. And then next, on technologically versus adoption. One of the big debates we have in a lot of the blockchain space is whether we want to prioritize getting it to everybody first or to perfect the technology first. And what the key, part of the ecosystem that investors play in is to be able to optimally fund that trajectory and take strong convictions over how to do that. And that brings us to even larger macroeconomic discussion, which is on geography. Between North America and Asia and Latin America, MENA, Africa, you name it, there are different needs to be met that blockchain has some sort of proposition for, but they differ massively. And that's something we'll be addressing as well. And then finally, the last thing is about exchanges, secondary markets, and liquidity. We'll talk a bit more about what kind of leverage they have in the whole ecosystem of crypto and blockchain startups, and what to generally look out for and what to know whenever a company says they're going to go mainnet and list on an exchange or do an IEO or an initial exchange offering on one of these exchanges. And yeah, with that, we'll obviously be sourcing a lot of your questions from this session, and we'll come up with hopefully the most effective topics to answer all of them in that masterclass. So thanks everyone again for joining, and looking forward to answering your questions.
Again, thank you so much for attending, and I wish you all have a great rest of your day. Take care. Bye-bye.
Thanks everybody.
Bye.